Welcome to my review of Chapter 14 of the Canadian Securities Course. In this chapter, we are going to be going over company analysis. So if you guys can remember back to Chapter 13, where we looked at fundamental analysis, based on fundamental analysis, you are going to be looking at a lot of financial ratios to evaluate companies. And basically, this chapter is going to be going over the actual way of analyzing companies using these financial ratios. So it is going to give you a further insight to fundamental analysis as well. So first off, there are four main types of financial ratios. You have the liquidity ratios. So these are used to judge the company's ability to meet its short-term commitments or short-term debt. And the main ratios that we are going to be looking at include the working capital ratio and the quick ratio, also known as the current ratio. We also have risk analysis ratios. These show how well the company can deal with its debt obligations. Obviously, if a company can't deal with these debt obligations, they are more risky, which is why it is risk analysis ratios. And these ratios include the asset coverage ratio, debt to equity ratio, cash flow to total debt outstanding ratio, and the interest coverage ratio. Operating performance ratios, these illustrate how well a management is making use of the company's resources. These are pretty straightforward ratios as well. They're gross profit margin, net profit margin, return on common equity, and inventory turnover ratio. Now we also do have value ratios. And these really show the investor what the company's shares are worth or the return on owning them. And we are going to be looking at the percentage dividend payout ratio, the earnings per share, dividend yield, equity value per common share, and of course, the price to earnings ratio. Now, moving on to liquidity ratios. So we have the working capital ratio, and this is essentially a ratio that measures the ability of a company to meet its obligations, mainly short-term debt. So the ratio is calculated based on current assets divided by current liabilities. It really shows how well your current assets can pay for those current liabilities. You will want this ratio to be higher in order for that to be a positive sign. Normally, companies with a working capital ratio of 2 are pretty good, but it does depend on the industry. So current ratio, this shows how well current liabilities are covered by cash and by items with a ready cash value. And that ready cash value is a really key part because this ratio takes current assets minus the inventory. So basically just those current assets that is ready cash, and they divide that by the current liabilities. So very similar ratio to the working capital ratio, except they do take out that inventory. Now, risk analysis ratios. So first off, we have the asset coverage ratio, and this shows a company's ability to cover its debt obligations with its assets after all non-debt liabilities have been satisfied. So to calculate this, you are going to be taking tangible assets and divide it by the current non-debt liabilities. So this would be current liabilities minus the short-term debt. And then you will be dividing this by total debt outstanding. Now, tangible assets, it means the company's total assets less goodwill or other intangible assets. Basically, it is just the physical assets that you actually can touch. And this ratio really does allow you to see how well the company can cover their debt with its tangible assets. So a higher number would be better for this ratio. Now, debt to equity ratio is quite straightforward. It is calculated by taking the total debt outstanding and dividing it by equity. So this shows the proportion of borrowed funds to equity, and a lower ratio tends to be better, since if the ratio is too high, it means the company may have borrowed more money and they could be at a higher risk of bankruptcy. And so some other risk analysis ratios include the cash flow to total debt outstanding ratio. So this ratio gauges a company's ability to generate funds internally and repay the funds it has borrowed, and a high ratio is considered to be positive. It is calculated by taking your cash flow from operating activity. This is also just company profits plus depreciation and amortization, minus all additions not received in cash, and then you also do add the changing working capital, which is just current assets less current liabilities. So the change in those, and then basically you will take the sum of this and divide it by total debt outstanding. Another risk analysis ratio includes the interest coverage ratio. This is a really useful ratio because it does reveal the ability for a company to pay the interest charges on its debt based on their profit. Now, a higher ratio is always better. It just shows that the company is more accessible to paying down its interest charges on this debt, and it is calculated as earnings before interest and taxes divided by interest charges. Now we will be moving on to the operating performance ratios, which show how effective management is using profits. So first we have the gross profit margin. This ratio is calculated as gross profit divided by revenue, also just revenue subtract the cost of sales divided by revenue. And it is used as an indication of the efficiency of management in turning over the company's goods at a profit. Now, net profit margin is another ratio that helps evaluate management effectiveness. It is calculated as profit less the share of profit of associates and then divided by revenue. Some other operating performance ratios include the return on common equity. It is a pretty simple ratio. It's just the profit divided by total equity, and it shows the dollar amount of earnings produced for each dollar invested by the common shareholders. Inventory turnover ratio measures the number of times a company's inventory is turned over in a year, and it is calculated as cost of sales divided by inventory. Now we have value ratios, which are primarily used by investors to show them how much a company is actually worth. Now these ratios, they are often used for fundamental analysis, as I mentioned, and the first ratio we have is the percentage dividend payout ratio. So it is calculated as common share dividends divided by profit, and it basically just shows the percentage of a company's profits paid out to shareholders. And just a note, this is different than the dividend yield, which we will be going over in the next slide. Now, another value ratio, one that is extremely important and widely used in the industry, is earnings per share. So it is calculated as profit divided by the total common shares outstanding. So this shows investors how much profit the company is generating for each common share. You can also calculate diluted earnings per share, and the only difference here is that you will be dividing by the total common shares outstanding plus any outstanding stock options, warrants, or convertibles. So these do need to be considered since, of course, if there are more stocks issued, it will dilute that earnings you get for each share since there will be more shares available. Now, some other value ratios include the dividend yield. This is very straightforward, and I'm sure all of you know what it is. But if not, it is just your annual dividend per share divided by the current market price of the stock. Now, equity value per common share is equal to the equity divided by total outstanding common shares. Pretty straightforward there as well. And then finally, we do have price to earnings ratio, or also known as the PE ratio. So it is an extremely popular metric when evaluating a stock or even the market as a whole, and it is calculated as market price per share divided by earnings per share. Now, basically, this metric shows how much an investor is willing to pay per dollar of earnings. So if a company has a PE ratio of 30, then investors are willing to pay $30 for every dollar of earnings that the company makes. Now, the last part of this chapter is the dividend discount model. And basically, this model relates a stock's current price to the present value of all expected future dividends. So it is calculated as the dividend for the current year, and then you want to times it by 1 plus the growth rate for that dividend. And you will then divide it by the rate of return minus the growth rate. Now, this model allows us to calculate the intrinsic value of a stock, and this can sometimes be used to determine if a stock is undervalued or overvalued. But anyway, those are all of the most important concepts in Chapter 14 of the Canadian Securities Course, so stay tuned for Chapter 15.